Ever wondered if that spare change you're investing with Acorns could actually disappear? It's a question many new and even seasoned investors using the platform might have tucked away in the back of their minds. We're constantly told about the power of investing, the magic of compounding, and the potential for long-term growth. But what about the flip side? Can you actually lose money with Acorns? Before we dive into the nitty-gritty, let's quickly recap what Acorns actually is. For those unfamiliar, Acorns is a popular micro-investing platform that allows you to invest small amounts of money, often by rounding up your everyday purchases to the nearest dollar and investing the difference. Think of it as a digital piggy bank that automatically puts your spare change to work in a diversified portfolio of exchange-traded funds, or ETFs. These ETFs are designed to track the performance of various market sectors, like large-cap stocks, small-cap stocks, and bonds. Now, the core question remains, can the value of these ETFs, and therefore your Acorns investments, go down? The short, honest answer is, absolutely. It's crucial to understand a fundamental principle of investing: all investments carry some level of risk. When you invest in the stock market, whether directly or through ETFs like those used by Acorns, the value of those investments can fluctuate. This fluctuation is driven by a multitude of factors, including economic conditions, company performance, investor sentiment, and even global events. Let's consider a few scenarios to illustrate how you could potentially lose money with Acorns. Market downturns. Imagine a significant economic downturn. Perhaps there's a recession, a geopolitical crisis, or a major global event that negatively impacts the stock market as a whole. In such a scenario, the value of the ETFs that Acorns invests in would likely decrease. If you were to sell your investments during this period, you would realize a loss. This isn't specific to Acorns, it's an inherent risk of investing in the stock market. Specific sector weakness. While Acorns diversifies your investments across different ETFs, it's still possible for a particular sector of the market to underperform. For example, if the technology sector experiences a slump, the technology-focused ETFs within your Acorns portfolio could decline in value. Although diversification helps to mitigate this risk by spreading your investments across various sectors, it doesn't eliminate it entirely. Inflation and purchasing power. Even if the nominal value of your Acorns investments doesn't decrease, inflation can erode your purchasing power over time. If the rate of inflation is higher than the returns you're earning on your investments, the real value of your money, what it can actually buy, will decrease. While Acorns aims to provide returns that outpace inflation in the long run, there is no guarantee this will always be the case, especially in shorter time frames. Your investment timeline, the length of time you keep your money invested, plays a significant role in the potential for loss. Investing is generally considered a long-term game. Over longer periods, the stock market has historically shown a tendency to rise, helping to offset short-term fluctuations. However, if you invest with Acorns for only a very short period and the market experiences a downturn during that time, you're more likely to sell at a loss. The importance of understanding risk tolerance. Acorns offers different portfolio options with varying levels of risk, typically categorized as conservative, moderate, moderately aggressive, and aggressive. These portfolios allocate your investments differently across stocks and bonds. More aggressive portfolios have a higher potential for growth but also carry a higher risk of loss, while more conservative portfolios aim for lower volatility but may also offer lower potential returns. Choosing a portfolio that aligns with your risk tolerance and financial goals is crucial. If you're uncomfortable with market fluctuations, a more conservative approach might be suitable, even if it potentially means lower returns. Fees and their impact. While Acorns fees are generally considered reasonable, especially for smaller account balances, they can still eat into your returns over time. If your investment returns are minimal or negative, the fees you pay will further reduce your overall returns, effectively increasing your losses in percentage terms. It's important to factor in these fees when evaluating the potential profitability of your Acorns investments. Not a get-rich-quick scheme. It's vital to remember that Acorns, like any investment platform, is not a guaranteed path to quick riches. The concept of microinvesting is geared towards consistent, long-term growth through small, regular contributions. Expecting substantial returns in a short period is unrealistic and can lead to disappointment, especially if market conditions aren't favorable. The psychological aspect of investing, market downturns can be emotionally challenging. Seeing the value of your investments decrease can trigger fear and the urge to sell, potentially locking in losses. It's important to remember that market fluctuations are normal and that trying to time the market, buying low and selling high, is notoriously difficult, even for experienced investors. Staying disciplined and sticking to your long-term investment strategy, even during turbulent times, is often the best course of action. How Acorns tries to mitigate risk. While Acorns can't eliminate the inherent risks of market investing, it does employ strategies to help mitigate them. Diversification. By investing in a portfolio of ETFs that track different market sectors and asset classes, Acorns aims to reduce the impact of any single investment performing poorly. Dollar cost averaging. The Roundup feature and recurring investments encourage dollar cost averaging. This means you're investing a fixed amount of money at regular intervals, regardless of the market price. When prices are low, you buy more shares, and when prices are high, you buy fewer shares. Over time, this can help to average out your purchase price and reduce the risk of buying high. Professional management. The portfolios offered by Acorns are typically managed by experienced investment professionals who make asset allocation decisions based on market conditions and long-term trends. Understanding your investment goals and time horizon. Before investing with Acorns or any other platform, it's essential to define your financial goals and your investment time horizon. Are you saving for retirement, a down payment on a house, or another long-term goal? A longer time horizon generally allows for more time to recover from market downturns. If you have a short-term need for the money you're investing, the risk of losing money is significantly higher. The importance of financial literacy, understanding basic investment principles, such as risk and return, diversification, and the impact of inflation, is crucial for making informed decisions about your money. While Acorns simplifies the investment process, it's still beneficial to educate yourself about how the market works and the potential risks involved. With that said, thanks for watching and until next time.